Right now, we're going to talk all about exploring the evolution of supply chain finance. There was a session that occurred on that yesterday, and we're now going to sort of take stock and find out what were the main highlights of that session and look ahead to the future. So let me introduce you to our panel of experts. Alexander Malaket is with us. He's the president of Opus Advisory Services. Gary Slaughter is a corporate treasurer at Octal Petrochemicals. Anand Pandey is the global head of trade at RBS, and Kat Chai Tan is the chairman of the International Chamber of Commerce Banking Commission. Also with us, Ashutosh Kumar, he's the MD Transaction Banking and global head of corporate cash and trade at Standard Chartered Bank. Guys, thanks so much for joining us. Thanks for your time. I want to start first of all with you, Alexander, because I want a sort of easy definition, if you like, of supply chain financing, because I know it means a lot of different things to different people.
Absolutely, Kavita, thank you. So just by way of initial reference and subject to great correction by my fellow panelists, trade finance typically involves some form of financing solution, risk mitigation, or payment solution around the transactions between an importer and an exporter. It tends to be a bilateral type of structure historically. Now, supply chain finance is an attempt to look at that a little bit more holistically. Instead of just looking at the importer and exporter, the notion is to look at the supply chain more broadly and try to determine what kinds of solutions can be brought forward in support of those supply chains. So
I want to go to you, Gary, as a client of all these guys, if you like. What are some of the needs that you have in using these kinds of products?
Well, first of all, I start from the real supply chain. I get shouted at by my procurement people because if I don't have enough banking facilities for them to pay for the raw materials. I get shouted at by the production people because there aren't enough raw materials to keep the chemical reactors going. And I get shouted at by the sales people because they say, you won't allow me to sell to anyone because they're all bad credit and you need to have that covered. So when we talk about risk mitigation, to put it into English, what that means is that we need to make sure that the receivable turns into cash, that when customers buy something from us, we get paid in the end. And what it means on the supply side is that we can actually buy raw materials to create something that then turns into a receivable.
You've got three bankers, Kachai. I'm going to put you in the banking slot, if you like. You've got three bankers to your left, and I've been reading some of the highlights that came out of the session yesterday. And what are some of the bugbears that when bankers come to talk to you as a client that they're trying to shove down your throat that you don't really want to hear?
To be honest, they all think they know how to do my job better than I do. Very well they might do, but I'm the one sat there actually doing it at the time, so I'm the one who's got to put up with things. And what I want is just something really, really simple. I just want credit, and then I will make the decisions on how I use that, whether I use it for LCs, whether I use it for paying suppliers an open account, whether I use trade credit insurance. That's up to me. I will use the tools. What I want people is to give me the tools, not say, this is the way to do it, because what I end up with is something very complex, something that's onerous, something I have to recruit staff for to do daily returns and receipts. I don't want that. I just want some money. I'll make some more money with it and pay the banks back.
But we've been trying.
It was a very lively session yesterday.
Very lively session yesterday.
So we've been trying very hard to get Gary's job, but clearly we couldn't succeed. Right? So basically, if you're looking at why, the challenge is still supply chain financing is only meeting 10% of a customer's need. There's still $2 trillion of unmet financing needs. And why is that happening? And I think the answer is we have to listen to customers like Gary. And instead of having just products which meet a certain need, like financing receivables of our customers or getting financial inclusion in terms of getting suppliers who need access to capital, but the balance sheets don't require that. So that all is happening, but what's not happening is a total linkage where you're looking at buyers who are sub-investment grade. So as Gary said, all would like to go to Gary's world and say, please bank with us, because they're the big boys. But how do you take care of the small boys? That's the first problem. The second problem over here is that you're not looking at end-to-end, starting from the producers and then going to the ultimate consumer. So banks are cherry picking. And you can't cherry pick if you want to grow the pot. So I think what we've been trying to do is to get into the transaction right from the procurement stage. So not wasting Gary's time, but going to the procurement guys, the production guys, understanding the company better and having solutions which talk about, before even the shipment happens, can you take a risk on a supplier? And that's where I think performance risk becomes pretty important. And then looking at e-invoicing, like RBS, 250 billion invoices get prepared every year, and 90% are manual. So how much trees are getting killed, right? So we've been on the e-invoicing journey, trying to link that to supply chain financing, and that's where I think you see a lot of productivity and a lot of optimization. And one day I promise we'll make Gary a satisfied customer.
Well, I think we like demanding customers like Gary. We like demanding customers that makes us feel uncomfortable. The banking industry is no different from many other industry. Life is getting a lot more complex. I like to use the telco as an example. The telco has to share their historical monopoly with new providers like Twitter, Facebook, WhatsApp, and the list goes on. The banking industry is going through the same transformation. Increasingly, we find that in order to service clients, we have to work with the credit insurance companies, we have to work with the ECAs, the development banks, we even have to work with pension funds, sovereign wealth funds. That is the trend, all right? It's not about competition. From my perspective, it's all about how we work with various partners that goes beyond the traditional banking market. So watch this space. I think there's a lot more to be done.
What specifically needs to be done though?
End of the day, I think it's like what Gary says, the client wants credit facilities in order to support their trade finance business. Yeah, I think that is the core of it. What we need to do is to channel the liquidity from where it is today. Unfortunately, it's not quite with the banking industry today, all right? We have all heard that. There's plenty of liquidity. It could be in the pension fund industry, it could be with the sovereign wealth funds. It is really very, very far away from a company like the one that Gary represents. It's definitely even further away from the SMEs. So how do you get liquidity that's far away from one part of the world to the other part of the world? And that's what we need to do. We need to build a better platform to transfer that liquidity from this part of the world to where the needs really are.
I think if you think from moving liquidity, that is one aspect, but there are multiple aspects if you have to look at the customer and say, Gary, I need to do the financing for you. The first one is the financing, the second one is taking risk. And if banks have to take risk, the model which is currently being used has to change. The current model is look at a supplier from Gary, or Gary as a supplier, and say, what is the financial balance sheet strength of that particular company? And that is the traditional way to do it. In this age of innovation, that has to be supplemented, complemented with other means. What is the supply chain linkage between the supplier and Gary? This supplier has been supplying to Gary for how long? How many years? Is it 5 years? Is it 10 years? How strategic are the supplies to Gary? Would Gary support the suppliers if something goes wrong? What is the unresolved rejection rate between Gary and the supplier? And that, if you go into those level of supply chain linkages, coming very close to the company, doing an analysis into the supply chain of the company, bedding yourself into the supply chain of the company, that is when as a bank, you will be able to make the decisions. Do I do pre-shipment finance for him or not? Is this supplier, would the supplier be able to borrow money from me, convert, buy raw materials, convert the goods, and supply back to Gary, and get paid back from Gary? I think that paradigm has to change from a banking industry perspective. The old adage of using financial analysis, balance sheet analysis, has to change and move into the supply chain analysis.
What I would say though is the supply chain is not static.
Absolutely.
And that's why I quite often rant, as I do, about flexibility, because I don't know very often who our customers are going to be next week. Certainly on the resin side of the business, where it's very much a commodity business, we could be supplying to someone in the US, or Europe, or North Africa, or South America. I don't know, so building up that relationship with our customers isn't so easy. Similarly, I get squeezed by our suppliers because they're much bigger than us. We go back to the very basics that everyone who's done an MBA will know about Porter's 5 forces of competition. And we seem to get squeezed by everyone from every angle, and it hurts at times, which is why I take it out on the banks.
But that's why I think where we disagreed with you yesterday, Gary. And as you said, supply chains are not static, right?
Yeah.
They're dynamic. You want to grow your business. You want to go into new markets. So letters of credit won't be dead. Clearly, the question is different customers, different suppliers have different needs. I now know Kavita, I'm meeting her for the third time, but can I trust Kavita with $100 million? Maybe no.
Yeah, you can.
Maybe,
Why don't we try it?
maybe with 10 euros to start with, and that's where the LC comes in, right? Letter of credit, because Kavita, I want to work with you, and Gary's important customer, let's get a letter of credit. But as the relationship progresses, and you go to open account, and that's where I still will not trust Anita with $100 million, maybe $50 million. And that's where the BPO comes in, which Alex was talking about, that okay, $50 million, I take an open risk on Kavita, and $50, since RBS is always there, come to RBS for the bank payment obligation, and you have $100 million of counterparty risk.
But there are so many markets where the LCs just don't exist. I mean, we're trying out to sell to South America, and I get told by my salespeople, South America, 180-day credit terms, open account. The Chinese are doing it. If we can't do it, they will sell the resin there. So that market is.
So I think Gary, I think both of you are right. I think Gary is right,
very
and Anand is also
diplomatic
right. I work for a non-profit organization, right?
He's chairman of the ICC, so he's a diplomat, right?
This is, in the end, Kavita, this is a classic example of the Sibos theme of opening up the conversation. I mean, it's clear in terms of takeaways from yesterday, it's clear that there are opportunities for candid dialogue between the banks and their clients. It's clear that there's an opportunity for innovation and to think about things in transformational ways. And the dialogue last night and some of the excerpts from today clearly illustrate that.
So I think they're both right, and let me explain why. I like to say, I always use this analogy, all right? And the analogy is letters of credit, the disappearance of letters of credit will not happen before the disappearance of coins. Coins will not disappear, just as letters of credit will not disappear. They all serve a particular need. Letters of credit will serve a niche need within 14 trillion of world trade. It will not serve the entire 14 trillion, it will serve a niche need. And that need is a very important need. I do recognize that in the case of Gary, in the case of his particular industry, letters of credit is no longer the right instrument for it. And that's the reason why collectively, between the bankers and our corporate clients, we need to develop new products to fulfill that needs. And that's the reason why yesterday there was a huge debate about the BPOs. I think that's just the beginning. I think as an industry, we need to introduce a lot more products to capture and to serve the 14 trillion of world trade.
Yeah, and I think just to pick up from that, I mean, the letter of credit discussion to me is only a symptom of a problem. The underlying problem is different. If you look at the underlying problem, what guys are saying, there's two problems. One is he has a supply chain which is not static, which is moving. The only way, Gary, has to be even more engagement with the people who you need to engage in the banks. And it cannot be a relationship where you are using a bank as a provider of financial services. There has to be a partnership between the bank and the company and the corporate so that they all understand each other. Many markets, when we work with companies, they will say, you know what, on a regular basis, I need to borrow 10 million with you. But this is the month, a festival month, let's say in India, Diwali is coming. I need to stock up much more. For 2 months before that, I need to stock up to $15 million. I need to do that. As long as that conversation, that understanding is happening, it works very well. So that is the first problem. The second problem with letter of credit is that it is a cumbersome process. The whole world is moved from paper to electronic. At best, what we are trying to do in letters of credit is saying is, let's make it EUCP rather than UCP, electronic. Move, instead of paper, an electronic document. It has to move away from that. It has to move completely electronic, and that is where the BPO comes in.
One thing I would add, I'm not entirely unreasonable. Sorry.
We know that, Gary, we know.
But because one of the things that I have to understand, and I regularly try and educate my colleagues about from the corporate side, is that banks don't have unrestricted availability to give credit. Banks are a business. So two things. One, they have to make money at what they do. And two, they have to be certain they're going to get their money back. Just like I want to get my money from our customers, the banks want to get their money back from me, the product they've supplied to me that needs to come back. And for that, they require security. Now, all of a sudden, when you're talking about security, you're then into the realms of Basel III rules, you're then into all the regulatory restrictions. So the banks don't have unfettered access to do what I would like them to do. So they have to then say, look, we can give you what you need, but because we've got our constraints as well, we're going to have security. So we need security over receivables, and I'm sorry, if we have to give security over receivables, that then means you've got regular reporting. If we have to give security over inventory, they have to say, right, well, what form is that inventory in? Is it still in the chemical form? Is it in a finished product form? So I appreciate that all of that has to happen, and that, to be honest, is what adds a lot of complexity and a lot of the onerous, cumbersome nature, but I appreciate that, to be honest, the bank's hands are tied by the regulators. So we then come back to the regulators, and I wouldn't call ICC a regulator, but
it's definitely not.
yeah. Facilitator. But that's when we then come back to, and a big theme that I've noticed here at Sibos is regulation, is Basel III, is what the regulatory authorities put on. And at the end of the day, that has an impact back onto corporates. Sometimes I think it's worthwhile the banks just explaining to corporates as well, look, we don't have complete and utter freedom to do what we want. Our hands are tied as well, and this is why we need to have these particular structures.
I think, Kavita, I would like to say that I very much agree. I think that the discussion is a two-legged discussion. You have the corporates here and you have the banks here. There's one very important party missing, the regulators. All right. I would challenge Sibos. Next year, the same forum, invite a regulator, sit here. All right.
Perfect.
The
We're gonna do
regulator's
that.
role is to manage risk. We appreciate it. I think more important, the regulator's role should be to promote economic well-being. No different from all of us, all right? And I think the equation to promote economic well-being is not sufficiently debated.
Okay, well,
And economic well-being also means financial inclusion. So don't forget your small, medium enterprises. Don't forget buyers who are sub-investment grade, but then you can have performance risk and you can take risk on that. And regulators have to look at basically these things, unless and not a straight-jacketed balance sheet kind of approach, which restricts lending and capital.
But I would say there's a fourth party in here, which is coming right around the other way, and I'm starting to sound too reasonable now, but you do have a fourth party in which is the people who invest in banks, i.e. the depositors. So depositors, the regulator is there to really protect the people who are investing in banks, because I might be shouting at you going, I want you to take a risk on me. Your depositors might be thinking, we don't want to take a risk
like
on
me.
him. So I understand that again, the supply chain is the physical supply chain that I deal with. There is another supply chain, there is the monetary supply chain. Where does money come from in the first place? That comes from depositors and investors, and the regulators are there to look after the risk of those, and then it comes onto the banks to manage.
perfect, guys. Thanks very much for joining us. We've got to leave it there.